I'm pleased to introduce our next two speakers. Denis Drescher and Matt Brooks come to us from Impact Certs, a team developing impact certificates as a means of maximizing good while also maximizing profit. They'll be telling us about impact markets, describing challenges to designing a safe and efficient market for the retroactive funding of public goods using impact certificates. Welcome, Denis and Matt.
Hey guys, Denis is going to start, but I guess he's just connecting. I'm Matt Brooks. I'm part of the team. We're going to start with a bit of risks and risk mitigations to building an impact market. And at the end, we'll spend just 5 minutes showing what we're building, how we're building it, and how you can get involved. Denis?
Welcome to our presentation on impact markets. We are Candy, Matt, who just introduced us already, Dani, and me, Denis. And our goal is it to make public goods tradable. And our talk ties in with the talk by Owen Cotton Barrett that I also collaborated on at the last Funding the Commons. Now, our hope, as I mentioned, is to make public goods tradable. And you're probably all familiar with retroactive funding, so that it's easier to tell what has been good than to tell what will be good. And we would like to enable people to speculate on this retroactive funding in order to make it possible for especially people like serial charity entrepreneurs to get cheaper liquidity to very quickly bootstrap their charities. For example, the Against Malaria Foundation has taken them almost 2 decades now to get to the current scale. I think that the sort of team that they have behind that would have been able to do that within 5 or 6 years if they have had more funding from the start, get all this cheaper liquidity, incentivize excellence by enabling these talented serial charity entrepreneurs to exit from a charity that they have founded and that's running well and reinvest those funds into starting their next venture. The markets that will enable, and that is our hope, that'll enable this trade can then also aggregate a diversity of perspectives of lots of different speculators who all have their individual specializations. And with that, we're hoping to also scale priorities research in general. But unfortunately, and this is also the reason that I think this whole talk is basically a bit of a call to action to all of you. Unfortunately, we are facing major challenges here. We've identified a number of risks, and by risks, I don't mean mere failures that charity just sort of fizzles out, the founder team disbands, or they decide that their approach doesn't work. But by risk, I mean actual catastrophes where an organization has aims to have a vast positive effect, but instead has a vast negative effect in the end. An actual sort of civilization destroying catastrophe would be one of the worst cases. Some risks that we have identified are listed here. I will only have time to address the first two. I've termed the first one distribution mismatch, and the second one is sort of a superset that includes the first, but I'll treat it separately for clarity. And that is sort of a lack of incentives for moral trade on impact markets, at least impact markets naively conceived. Now, what we mean by distribution mismatch is that, as I mentioned, the impact distribution of charities can be vastly positive, but it can also be vastly negative. If you start some sort of AI safety organization and try to make artificial general intelligence safer, then you're of course aiming at a huge positive effect. But if you get this slightly wrong, you might instead have a vastly negative effect. And this symmetry between in the impact of interventions, or some interventions at least, and this is like more common than one might think, is not captured by profit, by the profit distribution. These two cases where a charity that just sort of fizzles out because like the founder team splits up or whatever, that case it will just lead people, investors, to lose their investment. And the other case where a charity has a vast negative effect will also just lead them to lose their investments. We're worried that this effect will lead investors, especially like purely profit-oriented investors, or like mostly profit-oriented investors, to invest like differentially into very risky ventures, very risky charities that have huge upsides with a small probability, and do so regardless of whether these charities might also have a huge downside. And the second one is moral trade. I won't be like, the second risk is like a lack of incentives for moral trade. I won't be able to do justice to this important concept here. Researchers like, I think, Toby Ord and Brian Tomasek here, where I purloined those diagrams, have already written about this. The idea is that it's very rare for two people in the world to have each only one preference, and for those two preferences to be completely opposite to each other. So in all other cases, it's possible for people to like slightly compromise on their goals, and like in this case, their moral goals. And that is like in aggregate, virtually in all cases, better than for them to like fight it out where only one of them survives and then can implement their preference in total. And in particular, the Pareto frontier is interesting, where such a compromise is as good or better than the fight case for both participants. Now, impact markets sort of by default don't have incentives built in to enable this. Like, for example, if two charities have interventions that are opposite to each other, they might sell their impact, and their impact certificates might have like a large positive valuation. But the impact that they generate just cancels out. And so the net impact of these two organizations is zero. How like all these social norms that we want to institute around impact certificates are like covered in more depth in Owen's last talk. Now, we've had a few ideas, a few like tentative ideas that are untested when it comes to mitigating these risks. I'll only address like the top two, as it were, of these potential solutions. The first one is attributed impact, and the second one is something that I call the pot, which is sort of like a poker metaphor. And then there are a few more. Generally, I think about this along the lines of like just throw everything at it and try to add as many like redundant safeties as possible in order to like reduce the risk that something goes wrong as much as possible. And one of these that I won't cover in depth sort of aims at people putting some collateral at stake. There are also some plans that like the Global Priorities Project had for like insurance, for work, like for biosecurity work. That's generally probably going to be very difficult, because when we're really thinking of like civilization destroying kinds of catastrophes, then the amount of collateral that people would have to put at stake is enormous. And that's why this doesn't really seem like a very viable way forward. Instead, my solutions mostly aim at making it maximally unattractive for investors to invest into things that have huge downsides, and thus, by extension, also for issuers to issue impact certificates that describe actions that have vast downsides. Now, the first one is the first like mitigation method is a definition of impact or like a responsibility for impact that I've termed attributed impact. This is sort of the first alpha version of it, version 0.1. It might look a bit complicated, but really what it aims to do is simply to, one, just capture our intuitive notion of what impact is, and to like make clear that certain edge cases that lead to perverse incentives are excluded from that definition. So I'm trying to like operationalize what we mean by impact a bit more here. And attributed impact has like a whole bunch of aspects. I'll draw attention in particular to 4 of them. First of all, it is a responsibility. And by this, I want to appeal to like common shared notions and social norms and laws and rights that we already have in our culture that are that we have like sort of a shared understanding for. I don't think there is any fact of the matter, like who has affected how much impact, but we can rely on shared social norms to agree on allocations of impact. And that's why I call this a responsibility. The second is like the second important keyword here is justified by those who make the claim to this responsibility. And the idea behind that is that any issuer of impact certificates needs to argue that they are the ones that the action that they are planning to carry out at this time when they're issuing it fulfills and this definition and like has a positive attributed impact in order to like appeal to investors. So this is one of these drivers of adoption that I've put in here. My general idea is to bring like retroactive funders on board with valuing impact according to this attributed impact definition, but also to put in like a self-reinforcing feedback loop of sorts, where issuers need to argue that their impact is positive according to this definition, thereby draw the attention of anyone who looks at the impact certificate, but also draw the attention of like like speculators in particular to attributed impact, and also to draw the attention of anyone else who wants to issue impact certificates to this definition of attributed impact. There are a few more drivers of adoption in here, and they are meant to really institute attributed impact as a Schelling point for how impact is valued on impact markets. But that also means that it is very important to get this right. So we want to be very careful to like try to red team these measures as much as possible and develop additional measures and test them out very carefully. Because if we get something wrong, but the self-reinforcing feedback loops actually work, then that might be a problem. The second part of the definition describes like a minimum between what I call like ex ante and exposed subjective expected change. Expected refers to expected value. And the minimum has the effect that if we are dealing with one of these extremely risky interventions, then they have huge upside and huge downside, and these two cancel out to something close to neutral. So in ex ante, before the action has been taken, our subjective expected value that we assign to this impact is neutral due to this canceling effect. And the minimum has the effect that regardless of how this turns out in the end, the attributed impact is always capped at this neutral point. So it is already obvious for all investors and also for the issuer that if their their subjective expected impact before they've implemented the action is neutral, then it can never exceed that neutral point. So issuers can anticipate that, so speculators can anticipate that retroactive funders will not value this impact, and issuers can anticipate that speculators will not value this expected impact. So this is our attempt at mitigating the risk from this distribution mismatch in order to make these risky interventions as unappealing as possible for all market participants. Then I already mentioned the third sentence with regard to the expected value. The fourth one, the important word in this sentence is all public goods. So so attributed impact describes a change in the aggregate supply of all public goods. So an issuer can't just pick out one moral dimension along which they want to have their impact certificate measured, which might then run counter to something that someone else is doing, and their actions might cancel out, but they have to argue why their action is a compromise between all the moral goals of all the moral goals of all agents who are capable of holding preferences. That is also the responsibility of the issuer, and of course all of this is a market run by people. So all of this they can appeal to human intuitions for making this case. But I don't want to fully rely on all retroactive funders just adopting the attributed impact definition and then this feedback loop starting, but I want to also have additional methods in place in order to try to drive this adoption, at least once we have red teamed it to a sufficient degree. To this end, I've had this idea of the pot. So when someone, and this example is about the Against Malaria Foundation planning a net distribution. I should note, I'm not actually in touch with the Against Malaria Foundation about this. It's just an example. They are planning a net distribution, and they have completely profit-oriented investors on board with this venture capitalist, these venture capitalist firms above. They also are cooperating with Concern Universal, another charity. Everyone who holds part of this impact certificate, some of them because they are collaborating with the Against Malaria Foundation on this, and others because they're financing the net distribution, can put some money into the pot. This pot is just works almost like any other retroactive funding, except that anyone who holds shares can put money into the pot, and then when an expert jury that is associated with this pot that manages it decides that some impact that has been realized is valuable, then this pot uses some fraction of the money that it has collected in order to buy some of that impact. And the profit-oriented investors, or really all investors, can use the amount of money that they put into the pot in to determine how much, what fraction of this budget is used to buy the impact that they own. Now this is what this looks like when you play through one scenario. The details of this table are not very important, but what is important to notice is that the pot in this case starts out with 10 million already in it. That is quite a large amount. Another thing that's important to note is that the venture capitalists in the end make a slight profit with this net distribution. Concern Universal and AMF also make profits, especially especially because they value the social bottom line. Now, this brings us to the limitations that I see for the pot. In this case, it was only profitable because the pot already had some money in it, either from like additional seeding of the pot or because a few other people had previously bid on impact certificates that the pot has not yet decided to buy or might never decide to buy. But I think that at least at first, this limitation might actually be an advantage because so long as we are not absolutely sure that the incentives that we're setting work on this market, it's probably better if the market is only appealing for people who value the social bottom line, so people who are somewhat altruistic, so that we can reason with them not to follow the market incentives if the incentives are misaligned, if the incentives lead to like perverse outcomes. There are also like marketing drawbacks yeah, for example, profit-oriented investors might have an incentive to try to draw novice investors onto this market in order to get them to invest into the pot and bet on impact certificates that are very unlikely to like be bought by the pot, like things that the jury will never find to be particularly impactful. And then the more sophisticated investors can profit from the money that these people have put into the pot and never won back. And this is sort of along the lines, like I see similar dynamics on lots of financial markets. And I'm not so happy about this market having the same like incentives, but that's like one of the examples of like a risk that we don't have any good like response to yet. Yeah, there are some other risks as well. And generally there are lots of open questions, and I would really like to see a lot more thinking about this, a lot more red teaming, and also a lot more thinking about like what other risks there are that we may have been overlooking so far. And with that, I would like to hand over to Matt.
Thank you, Dennis. So obviously he just spent a lot of time on risks because we're very early days, and that's probably the most important thing that we need to be thinking about right now. So where are we now? We're number one, trying to grow the community of thinkers. This is what this talk is about. It's a call to action. Please join us and help us think about risks, think about mitigating these risks, think about how we want to build this thing because we're in the early days of thinking about it. So that's the most important thing is help us think about it. So number two, what's most important is, again, that's what this talk is about, risks and mitigations. You don't want to start a market with bad incentives and bad feedback loops that will kind of spin out of control. So we're thinking about that mostly. But then number three, there's a lot of decisions to be made. There's a lot of ways you could build this market. There's a lot of ways you could incentivize the market, build the impact certificates, things like this. So we're thinking of implementation decisions. So help us think about that. And then number four, we're actually building it, coding it, writing it, promoting it, marketing it, designing it, whatever. We're going to actually be building it in the future. So join us for that. Eventually, we will probably need to raise some funds to do simple things like smart contract audits. That's probably pretty cheap. Maybe we want to pay for some contributor compensation, so maybe a bit more money there. But probably the most important part is that pot that Dennis was talking about, some sort of kind of market bootstrapping. You could maybe call it an impact treasury or something like this. It would be great to raise funds for that kind of promised capital, either in like a true multi-sig kind of treasury, or maybe even just some people promising to buy some impact certificates. So there's some sort of like promised capital to come into the market to kind of bootstrap it. That's where we are now. And what have we built? Well, I just mentioned the ETH Denver Hackathon. We actually did build and launch something just to kind of introduce the idea to people and get it kind of into the public goods kind of mind space. So it's at impactcerts.com. This is obviously like very alpha, version 0.1. We're just on the Ropsten testnet, so nothing's obviously launched for real. But we're trying to do a few things here. Number one, explain the idea. Probably a lot of people haven't heard of impact certificates outside of the people listening to this talk. So we want to explain what we're going for. What is this? Well, maybe a bit of a background and what we're aiming for. An FAQ as well. There's probably a lot of initial questions, confusions, definitions, things like this that we want to explain. But we did build some kind of cool stuff. So number one, you're going to probably want to be able to mint your own certificates. Obviously, this will be like an open source, free public good. Obviously you just have to pay for the gas. But you can mint your own test impact certificate. So for now, you can put the name, description, who's going to be holding it up, maybe you. You can tag it as well with what public good you're kind of impacting, some maybe external URL, and of course an image. And so you can mint your certificate and it will go into our gallery. So there should be a place to view these certificates, review them, share them, compare them, whatever it may be. And so you can think of a lot of options here. You could think of different views, filters, categories, different verified galleries for different organizations or for different categories. You could even have some approval whitelists or like badging or verification. I know Juan was just saying that auditing and verification is very important. That's true. You don't want to be buying fake impact certificates, obviously. So there will probably be some sort of, you could say like verification DAO or something like this that can produce like a whitelist of what they think are the best ones, or ranked lists or stamp of approvals, whatever it may be. So you can have a bunch of different kind of ideas about how you display these impact certificates. And then you would need some way to sell and buy them. Obviously, if it's just an NFT that you hold in your wallet, you can sell it on OpenSea or something like that. But there could be other interesting ways to sell impact certificates. One of them could be what we consider a ratchet auction that we've built. It's inspired by the Harburger tax, with the idea that whoever values the impact the most should just be able to own it. You shouldn't be able to refuse a bid, basically. So you can lock your certificate into this auction. It will spit back out like a wrapped certificate that's managed by the auction. And you can set a bunch of parameters about how much speculators make and how much of the profits flow back to the issuer, things like this. And then it just kind of is a perpetual auction that never ends, and whoever wants to own the impact can just own it. So that's kind of one interesting way you could sell it. And then, of course, you should allow people to buy it. So either from the ratchet auction, you could buy it from the gallery itself if they're willing to sell it. There's basically thousands of options here, and we're trying to explore them. So this is obviously very early days. This is just something we built in a weekend at a hackathon. So obviously no final decisions have been made about this. We actually just want more people to come into the space and help us think about risks, mitigating the risks, and design decisions. So join the Discord.